What's up guys, Jake here, welcome back. In today's video, we're going to do another options trading example, this time how to sell covered calls on Vanguard's platform. I'm already assuming you know the basics of selling covered calls. If not, check out my options trading playlist on YouTube, and this video right here, how to sell covered calls, goes much more into detail and strategy when selling covered calls, but in this video, we're going to do an example with Vanguard. And up front, Vanguard's website is not state-of-the-art. It definitely could use a refresh or an update. So I have to do this with screenshots because my full name and account number is everywhere and I don't want to take the time to blur that out for you. So we'll do this with screenshots. First thing before you can trade options with Vanguard is you have to enable margin and apply for options trading. So on the buy-sell page, you're going to go down here and click on Trade Options. It's going to give you a pop-up where you're going to have to go to the application. Here's the search results. It's the top one, Options Investing at Vanguard. And then you're going to submit an application, wait a couple days to be approved. Now, what you tell them is up to you to get approved. Vanguard has several levels of options that they'll approve you for. However, the good news is level 1 is just writing covered calls. Income and hedging, it's the most conservative form of options trading you can do. However, if you want to get approved for writing covered calls and selling cash secured puts, I have another video talking about that, then perhaps you want to apply for and get approved for level 3 trading. So a couple days have gone by, you've been approved for options trading with Vanguard. The next step is to have 100 shares of a stock. In order to sell a covered call, you're writing one contract and you have to have in your possession 100 shares of stock. For this video, let's do an example of Bank of America Corp. I just bought 100 shares today. If you don't know how to buy stock on Vanguard's platform, I have a video for that as well. So my cost basis was about $3,826, and I started with about $5,000 in this account. So first step in selling a covered call is to go to the buy and sell page. Once again, go to the bottom and click on Trade Options. This is going to bring up the options trading interface, which looks exactly like their stock and mutual fund buying interface. However, you're going to click up here on Option Type, and we're going to be selling a call. So option type call, transaction type sell to open. It even says right here, covered calls only. This will bring up a pop-up where you have to select what stock you want to sell a covered call on. So if you don't have 100 shares of a stock, it's not going to let you go past this point. So I have exactly 100 shares of Bank of America Corp. I'm going to select that and hit continue. Next, you have to choose your expiration and strike price, and I'll be honest, with Vanguard's platform, you kind of have to know what you want. Their user interface isn't really going to help you, but go ahead and click on this link for choose from a list of options. It's then going to bring up a pop-up where it'll show all the strike prices down here. For expiration dates, we're going to select May 21st. The reason why is because the third Friday of every month has the most liquidity, the most people buying and selling options. So the sweet spot when selling covered calls, in my opinion, is selling a covered call 2 weeks to 1 month out so that the buyer is losing most of their value, their extrinsic value due to Theta Decay. So you as the seller are making money the fastest, in my opinion. So when you click on these strike prices, it'll populate over here. The shaded yellow are in the money strike prices. The white are out of the money. So the last trade, the current share price of Bank of America, is $38.48. So if the strike price is above $38.48, it's out of the money. There's no intrinsic value yet. And if it's yellow, it's below $38.48, and it does have intrinsic value. So the options premiums, what buyers are bidding and sellers are asking, increases as you go down in the share price, in the strike price. Now, something useful to reference when selling covered calls are the Greeks. However, Vanguard's platform does not provide them to you. You can't check delta, you can't check implied volatility, you can't check theta. So you have to go on a third-party website in order to check these metrics to know what you want to buy with Vanguard. Now, there are lots of third-party websites you could go on to check the Greeks. However, I'm going to go on Robinhood for fun since that's Vanguard's competitor. And we're going to type in BAC for Bank of America Corp. And then over here, we're going to click on Trade BAC Options. Now, to find the identical chain, we're going to click on Sell a Call and the expiration date of May 21st. So here is the option chain. Once again, Bank of America is currently 38.52. The market is open today. So if we click on the strike price of 39, it's giving us a delta value of 0.45. What does that mean? It's telling us that there's a 45% chance that we're going to get assigned that this contract will expire in the money and our 100 shares will be called away. Now, of course, you're still collecting the premium, you're still getting paid the strike price, which is ideally above your cost basis. But when selling covered calls, so you're not always getting your stock called away, the sweet spot you want to look for is about 30%. So let's click on the strike price of $39.50. The delta value is 38%. Let's click on the strike price of 40, and here we go. The delta value is 0.32 or 32% chance of this expiring in the money. So I'm going to go with the strike price of 40. The next thing you can reference that's useful is implied volatility, and it's saying that IV is 26%. What does this mean? This is measuring how volatile this option contract is and how much it's moving around. The higher the IV, the more option premium you as the seller can collect. So if IV goes up, if it's in the 30s, 40s, 50s, 60s, then these premiums, what buyers have to pay you, you're the seller, so you're getting paid, what buyers have to pay you increases. So a value in the 20s isn't very good, but Bank of America is a very large, stable, predictable blue cap stock, so there's not a lot of volatility. But if you own the stock and you want to sell covered calls on it, you're still getting a good premium in my opinion. So back to Vanguard, and we're going to go to the strike price of 40 and click this hyperlink that says trade. It's then going to populate the expiration date of May 21st, which is about a month from now, and then the strike price of 40, quantity 1 contract. I'm selling 1 contract because I own 100 shares. Order type, you can do a market order. It'll just fill it wherever the buyers are bidding, but if you want to do a limit order, that's more predictable. You know exactly what you're getting. Now over here, the buyers are bidding 60 cents, multiply by 100, you're getting paid 60 bucks, and the sellers are asking 61. Because Bank of America is such a large, frequently traded stock, the bid-ask spread is very small, only $1. So if you want to be greedy, you can put a limit price in for 61. You'll probably get it filled pretty quick. But for the purposes of this video, I selected 60 because I wanted to get filled right away. And I'll be paid $60 for the premium. Commission for the Chicago Board of Options Exchange, Vanguard, is taking $1. So the net amount is $59, and we can click continue. This is the review and submit page. Everything looks good. You're going to click on submit. Now on my account holdings page, let's think about what has happened. So because you sold a call, here it is right here, Bank of America, C for call, strike price of 40, and it expires on May 21st. So current balance is reading $60. The reason why, my account balance has not increased by 60 bucks yet. The reason why is because this contract still has value, quantity -1, negative value. So slowly over the next month, the remaining extrinsic value of this contract is going to waste away. That's called Theta Decay. So if the share price of Bank of America doesn't go up, then the buyer is not gaining on the strike price. They're not increasing the amount of intrinsic value in the contract. So this $60 is going to slowly waste away if Bank of America's share price stays flat. So in a week, maybe it'll be down to $48. In 2 weeks, it'll be down to $30. With 1 week going, there might be $15 left. And that's when my account starts going up. So if by expiration date, Bank of America's share price is not above 40, this goes to zero. My account balance net is up $60. Now, selling covered calls is the most conservative form of trading options because you can't lose. So I bought $3,800 worth of Bank of America stock, and I'm selling a covered call for a strike price of $40 a share, or $4,000. So if I am wrong on this bet, if you want to call it, then somebody is going to pay me $40 a share for my 100 shares. However, I only paid $38.42 for it. So I don't care if somebody wants to pay me a profit of I don't know. I think that's like a 4% increase on top of the $60 premium that I made in 1 month. So the difference here between 4,000 is $158 plus 60. What is that? 100 and I'm doing public math. I'll get my calculator. So we have, what did I say? 158 plus 60, 218 bucks. If you want to make 218 bucks in 1 month by being wrong and your option is exercised, you lose your 100 shares. That seems like a really good deal to me. If I'm wrong and Bank of America's stock price goes down or stays flat, I hedged and I still collected 60 bucks, lowering my overall cost basis. So let's say I sell a covered call every month to make 60 bucks and I'm right every time and I never get my stock called away. On equity of $3,800, I'm making 60 bucks a month. So 60 times 12 is $708. 708 divided by 3,800. I'm making 18% on my equity a year by selling covered calls on stock that I don't mind holding anyways. That's a pretty good deal. So for those reasons, selling covered calls, if you're someone who owns a lot of stock, is pretty nice. Just make sure that your strike price is always above your cost basis so that you're never technically losing money. Now, yes, Bank of America stock could shoot up dramatically. It could go to $42 a share. Your stock's going to get called away. Your net down value, but once again, as long as the strike price is above your cost basis, you can't lose money selling covered calls. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. In addition, check out that options trading playlist. There's definitely a lot of good information there that I've been accumulating and building over this year. Till the next video, take care.